Online trading is more common thanks to technological advancements. The hassle-free and quick nature of online trading has drawn a lot of corpus-building investors. You should be prepared if you're just starting out in stock trading. Purchasing stocks is simple. Selecting businesses that consistently outperform the stock market is difficult. You're looking for stock tips because that's something that most people can't perform. After watching this video, you will learn how investing works and the risks and benefits of investing. Today, we will look at 5 essential investing tips that will definitely help you. Let's start our video. Especially over the long run, the stock market has the potential to offer investors significant profits. However, making money in the stock market could be difficult for novices unfamiliar with how the market operates. Although there is no guaranteed recipe for success, some market experience will help you determine the best investment approach. Remember that investing in the stock market needs perseverance, self-control, and a methodical approach. Also, keep in mind specific fundamental stock market advice that, if used wisely, could lead to profitable outcomes. They might assist you in making wise investment choices and averting losses. Let's look at the 5 things every investor has to know before they start trading. The ideas listed below will provide tried and true guidelines and tactics for stock market investing. 1. Check your emotions at the door. Warren Buffett, chairman of Berkshire Hathaway and a frequently quoted investment sage and role model for investors seeking long-term market-beating wealth-building returns, once said, "Success in investing doesn't correlate with IQ. You need the temperament to control the urges that get other people into trouble investing." Buffett refers to investors who make decisions based on logic rather than emotion. In fact, one of the most frequent ways individuals reduce the returns on their portfolio is by excessively trading activity brought on by emotions. The following stock market advice can assist investors in developing the mindset necessary for long-term success. 2. Pick companies, not ticker symbols. It's simple to overlook that an honest company operates behind the alphabet soup of stock quotes that crawl along the bottom of every CNBC show. However, avoid letting stock selection turn into a vague idea. Always remember that you become a shareholder in a firm when you purchase shares of its stock. As you investigate potential business partners, you'll encounter much data, but it's simpler to focus on the right things when you're in the business buyer hat. You want to know the company's operations, position in the market, competitors, long-term prospects, and whether it adds anything new to your portfolio of existing firms. Keep in mind, acquiring shares in a firm makes you a shareholder in that company. It's a good idea to understand the concept of diversity, which states that your portfolio should contain various types of businesses. I would advise against diversifying your businesses too much, though. Keep your investments in companies you are familiar with, and if you find that you are particularly adept at stock analysis, there is nothing wrong with having a sizable portion of your portfolio invested in that particular sector. While investing in glitzy, high-growth stocks may seem like a terrific way to increase your wealth, I'd advise you to wait until you have more experience. It's building your portfolio's foundation around dependable, seasoned companies better. 3. Plan ahead for panicky times. Every investor occasionally feels the want to modify their relationship with their stocks, but rash decisions might result in the classic investment mistake of buying high and selling cheap. Journaling is helpful in this situation. When your mind is clear, list why each stock in your portfolio is good investment, and the circumstances that might support a breakup. For instance, why I'm buying. Describe the aspects of the businesses that appeal to you and the possibility you see for their future. What do you anticipate? What benchmarks and indicators will you use to assess the company's development? List all conceivable obstacles and indicate which ones would be game changers and which ones would signal a brief setback. What would make me sell? There are valid reasons for breaking up occasionally. Write an investment prenup outlining your reasons for selling the stock in this notebook section. We're not discussing stock price fluctuations, especially not in the near term, but rather fundamental adjustments to the company that impacts its capacity for long-term expansion. Some instances include the company losing a significant client, the CEO's replacement steering the company in a different path, the emergence of a sizable viable rival, or the failure of your investment thesis after a reasonable amount of time. Investing based on rumors is something you should absolutely avoid doing in the stock market. Don't just invest in a stock because everyone else is doing it, even if a friend or relative recommends the store. Don't take the recommendation at face value. Investigate the stock thoroughly before investing. Analyze the company's growth prospects and performance. Recall that profitable stocks provide profitable returns. 4. Build up positions gradually. The superpower of an investor is time, not timing. The most successful investors purchase stocks with the expectation that they will be rewarded over years or even decades through the share price growth, dividends, etc. This implies that you have the freedom to shop slowly. The following 3 purchasing methods will lessen your exposure to price volatility. Dollar cost average. Although it seems complicated, this is not. Dollar cost averaging is investing a predetermined sum regularly, such as once a month or week. Generally, it balances out the average price you pay by purchasing more shares when the stock price declines and fewer shares when it increases. Investors can create an automated investing schedule with some help from online brokerage providers. Buy in thirds. Buying in thirds can assist you in escaping the demoralizing experience of having rocky outcomes straight away, similar to dollar cost averaging. As the name suggests, choose 3 different points to acquire shares after dividing your desired investing amount by 3. These may be based on performance or corporate events or occur at regular periods. For instance, you might purchase shares before a product's release and invest the next third of your funds if it becomes successful, or place the remaining funds elsewhere if it's not. Buy the basket. Unable to predict which business in a specific sector will succeed in the long run? Get them all. The strain of selecting the one is reduced when buying a basket of equities. If you invest in every player who passes muster in your analysis, you won't miss out if one succeeds, and you can utilize the profits from that winner to make up for any losses. This tactic will also assist you in determining whether a business is the one, allowing you to strengthen your position if necessary. 5. Avoid trading over activity. Here is one of the most crucial investment secrets, courtesy of Warren Buffett, the Oracle of Omaha. To get remarkable results, you do not need to do unusual actions. Investing in shares of successful companies at fair prices and holding onto the shares for as long as the companies are successful is the most reliable approach to making money in the stock market. This can result in some volatility along the way, but you'll generate good investment returns over time. Short-term noise rarely indicates how a carefully chosen company will perform in the long run. What counts most is how investors respond to the cacophony. Your investing notebook can help you persevere through the inevitable ups and downs in investing in stocks. It can act as that logical voice from simpler times. It's unnecessary to discover the following hot breakout stock before everyone else to be a successful investor. When you learn that a particular store is about to soar, thousands of skilled traders have already done so, and the potential has probably already been factored into the stock's price. While it might be too late to generate a quick profit, you're not necessarily late to the party. Active investing could be viewed as a hobby rather than a get-rich-quick scheme, since excellent investments continue to provide shareholder values for years. The significant earnings make trading in the stock market appealing to people. Remember that the markets are erratic, and stock values might change suddenly. Experienced investors, however, don't allow these risks to influence their strategy. Instead, they concentrate on research and analysis to decide whether to invest, where to invest, and whether to buy, hold, or sell a company. This trading advice might assist you in taking your first steps if you're just starting. Utilize them to establish a successful stock market investment strategy that generates consistent profits. That concludes today's videos. Check out more videos on our channel to learn more about investing and economics. Thanks for watching Proactive Investing, and we'll see you next time.